when I listen to them, I actually have always learned something that I didn't know. About this time of year, people in their business go hear about all the tax law changes too. And so there can be new things that you don't know about. They specialize with clients that have real estate rentals, and so they're a perfect match for what we do. And by the way, we wouldn't be speaking with any of these people if we didn't feel very comfortable with their character. That's really important for you to understand, that we feel very comfortable with everybody that's going to be up here, or they wouldn't be with this event. So Matt and Amanda, please come on up and do your thing.
Well, thank you, Bruce. That was very nice. That's a lot of pressure, when he says he's going to learn something every time we come up and talk. So now we're going to come up with some really good stuff, right? So welcome, everyone. Thank you again for joining us today. It's a beautiful venue. It's a beautiful day outside. So for you guys to come inside and fill up your bellies and then sit down and hear about taxes, I'm sure you're excited. So one of the things we like to do to start off every presentation is we actually do a pop quiz. And so it's kind of get your juices flowing. Now, here's the thing: is we're gonna bring up a question. If you happen to know the answer, just raise your hand. You don't need to yell out or anything. Just raise your hand.
The first person who answers it. Can you guys hear me? No? Okay, I think I'm on. The first person who answers it correctly will get one of our lovely free gift cards.
All right, so our first pop quiz question is, which of the following items may be tax deductible? A swimming pool, a clarinet lesson, weight loss programs, or all of the above? Go, sir, in the red. D. D is correct.
Yay,
all of the above.
Good job.
So the key here is to look at it from the perspective of these can all actually be deductible medical expenses if you have a doctor's note. Now, man, I don't remember what the clarinet lessons were. Something.
Yes, it was a child who had an overbite, and the mom talked to the physician, and the physician actually said clarinet lessons can help fix overbite problems. So this is to teach us to have a really good relationship with our physicians, right? If we have kind of funky stuff that we want to write off. We actually did have a client who had a swimming pool that we were able to get deducted because it was a medical-related reasons.
So our next question is, the IRS allowed which of the following people to take a tax deduction for their breast implants after a court hearing? Is it A, Dolly Parton, B, Lindsay Lohan, C, Chesty Love, or D, Bruce Norris?
Any takers? First row? Dolly Parton. That's incorrect.
A popular choice, but incorrect.
Chesty Love, yay, good job.
So if you were like me, when I saw this the first time, I said, who the heck is Chesty Love? That can't be a real name, right? Right. But if you go to Google Images and type in Chesty Love, you'll see that she comes up. But what's the best part about this? The IRS allowed her to take a tax deduction, but they said you can't write it off all at once, and why not? Because it's related to depreciation, so they're fixed assets, and they have a useful life of more than a year. Come on, it doesn't get better than that. So before we go to the next slide, one of the things that, I don't know if you guys remember kind of at the end of last year, there was a lot of talk about the imploding economy and what's going to happen with the fiscal cliff and everything's going to go over this imaginary cliff that was out there. And now what happened was, if you guys, at least if you believe what the media put out there, is that this was, what it came about was a win for middle America, right? They said taxes aren't going to go up, middle America is going to win. You guys remember hearing all that in the news around turn of the year?
How many of you remember what was the name of the tax law that came about at the beginning of this year, right after the fiscal cliff crisis was fixed? Anyone remember the name of it? Gina?
Yeah, I believe it was the American Tax Affordability Act.
Very close.
Very
close. Good job.
We'll give you bonus points. It was actually called the American Taxpayers Relief Act of 2012. So really interesting, right? Very ironic. You guys, feel relieved after everything came down. Most people don't. Well, so we're going to go over today. We're going to kind of talk about some of the changes that came about from this act and some of the myths and facts related to it, some of the changes in the tax law and strategies that you guys can implement to protect yourself going forward. Now, we were talking about this was at the end of last year. I mean, this is really the end of last year. This is like 11:50 p.m. on December 31st. They finally passed this act that, saved the fiscal cliff or whatever it was. So it was nice of them to plan ahead for all of us CPAs. So we just want to take a quick snapshot of what some of the tax rate changes have been and what you're looking at right now. So for 2013, the highest federal income tax rate did go up by 4.6% to 39.6%. Here in California, our highest state tax rate is 13%. Payroll taxes have gone up 2% for everybody across the board. Capital gains tax for all you real estate investors selling rental properties, your highest capital gains tax rate went up by 5% to 20%. And also, if you die without a good estate tax plan in place, you could be looking at estate taxes of up to 40%. And Teresa, our estate planning attorney here, is on our panel today. She's going to go over a lot of estate planning tips and tricks and things like that. So, what's missing obviously here is new taxes. So we're going to touch on that as well. One thing about the California rate, you see that it doesn't necessarily look like it changed from 12 to 13. But I don't know if you guys remember, probably middle of August, September-ish last year, California actually changed their 2012 tax rate and made it retroactive to the beginning of 2012. They upped the top rate by 3%. So it used to be actually 10%, and now it's at 13%. And so that was nice of them to do that 9 months into the year, of course, for all your tax planning. So let's go over myth versus fact. One of the things that came out during the tax change at the end of the year, what the media was putting out there, was that the tax changes are only going to affect those people making $400,000 as a single person or $450,000 as a married couple.
How many of you guys heard that a lot in the news media, right? Unless you make over $400,000, your taxes probably are not going up. And that is true for some people, mainly talking about income tax rates and capital gains tax rates. But next we'll go over the details of what other tax changes came about that impact people who make a lot less than $400,000.
So one of the facts, I sort of mentioned it earlier, that payroll tax increased for everyone across the board. And it went up by 2%. So somebody making $50,000 a year is now losing an extra $1,000 of payroll taxes.
Even someone who makes $20,000 a year in W-2 income or 1099 income, our payroll taxes have already gone back up as well as of January.
Then we sort of alluded to some new taxes. One of the new taxes that came out was, and stay with me here, this is called the Unearned Income Medicare Contributions Tax.
How many of you guys have heard of this tax before? Good. More and more
Some
people.
Moaning and groaning in the front row up here.
It's also commonly known as Obamacare tax, right? That's typically what the news media calls it.
Healthcare surtax is another name for it.
And it's additional 3.8% tax on top of the taxes that we already talked about on the previous chart. And don't let the name mislead you. Essentially, it's a new tax on investment income. So what are some examples of investment income that you guys can think about? Go ahead and shout it out if you think of anything. Interest income, if you have money in the bank, right?
Someone threw out flipping. We're going to talk about that in a second.
Any real estate investors in here? Okay. Net rental income is also considered investment income, so potentially subject to this additional 3.8% tax.
Yeah, doing trust deeds. This is something Karin Hall's going to touch on too in terms of what's a good investment for your self-directed IRA. That might be something like trust deeds you might want to look at because all the profit's going to go back to your IRA and is going to be free from this 3.8% tax. So you can kind of continue to defer the tax until future years.
Yeah, and for anyone who invests in the stock market, stocks, bonds, mutual funds, dividends, right? Anything subject to capital gains tax is potentially subject to this additional 3.8% tax if your income meets the threshold requirement.
Right, and one of the questions we actually get on this is actually related to capital gains is people kind of hearing in the media that, oh, I sell my primary residence, now I've got to pay this extra 3.8% tax. Well, that might be the case. So you sell your primary residence, as a lot of you probably know, you still, as a single person, can take up to $250,000 of profit tax-free. As a married couple, you can still take up to $500,000. But if you happen to sell your primary residence and your profit is more than that, then that profit could be subject to this new tax. Now, there is, Amanda alluded to it, there is a threshold for this. There's income thresholds before it kicks in. And that's $200,000 of overall income for a single person and $250,000 for a married couple. Now, Also, we talk about this is for real estate investors. This is really on any investment income, but one of the cool things for real estate investors is that unlike investing in stocks and bonds and mutual funds, you do get to take your deductions against your income before calculating the tax. So you get your depreciation, your mortgages, your property taxes on your rental properties, repairs, maintenance, all the usual stuff you get to deduct on your rentals. That kicks in before you calculate the tax. Now, the other new tax that came out as part of Obamacare, the health care surtax system, was one called the hospital insurance tax. And this is a new tax, again, 0.9% on earned income. So the other one we talked about was on investment income. Now they're trying to capture the other bucket of income that most people have as earned income. And this is on, when we say earned income, what are we talking about? We're talking about W-2s, 1099. Sir, one of you over there threw out flipping income earlier. If you're not doing it in the right entity and your flipping income is subject to self-employment tax, then this new tax could kick in and apply to your situation as well. Now, again, there is income thresholds for this one, just like the other one. The numbers are the same, but the actual what they're looking at is different. So before it was, in essence, adjusted gross income. This one is $200,000 of earned income for a single person, or $250,000 for a married couple. Now, if you're meeting the thresholds on this one, then obviously you're most likely going to meet the thresholds on the other one as well, because the other one is overall income.
So the two new taxes kick in for any individual making over 200 and married couple over 250.
This is kind of a round numbers to think about. And again, these are on top of all the other taxes we mentioned earlier that you're already paying. So something to kind of keep in the back of your mind. Now, one of the other things that came out as part of the tax changes,
the Taxpayers Relief Act.
Right. Is that there was a lot of talk, I don't know if you guys remember, there was a lot of talk out there earlier too about, well, we might take away some deductions or limit this, limit that. Now, a lot of people were thinking there's no way they were going to do that. But one of the things that did pass was that they are now limiting your itemized deductions if your income is above $250 for single or $300 for a married couple. Now, what itemized deductions, a lot of you may know, it's your property taxes on your primary residence, your mortgage interest on your primary residence, charitable donations, that's a big one for our clientele. Deductible medical expenses. I know I'm missing a few, but...
So in a roundabout way, the government has put in place new law that is now able to take away our mortgage interest and property tax and some other general itemized deductions, right, for those making over 250. I know a lot, that before they were talking about just doing away with, having, giving people the ability to take mortgage interest deductions. Did you guys hear about that in the media? And, I think that would probably have been political suicide for anyone who signed something like that into law. But this is a clever way for them to use phase out, essentially, as a way to limit our mortgage interest deductions. The good thing is the maximum that the government can limit in your mortgage interest deduction is up to 80% of what you pay. So if you paid $100 in mortgage interest, the most they can take away from you is $80 of it. You always get to deduct that last $20.
Isn't that generous?
Isn't that great?
So Bruce kind of alluded to this a little bit. Now is a great time of year for you guys to think about tax planning because you have the opportunity to do something before the year ends. And, the slide talks about what is year-end tax planning. I guess kind of the best way to look at it or give an analogy is think about a basketball game. So let's say you got the Lakers and the Clippers playing against each other, right? Now, for you non-sports fans, you don't necessarily care what happens for the first 3 3/4 of the game, right? You just care about what is the score at when the clock hits 0. Now, sports fans would argue that there's a lot of importance to the first 3.5 parts of the game, but really, it's kind of like taxes. Is what does your numbers look like on December 31st? It's going to determine for the most part what your tax situation is going to look like next April. There are some things we can still do in March and April, but a lot of your opportunities lie right now and put them in place before year end. All right, another pop quiz. Are we ready? Which of the following celebrities went to prison for failing to file tax returns? Is it A, Nicolas Cage, B, Lamar Odom, C, Wesley Snipes, or D, Diana Barley?
A gentleman right there. Wesley Snipes?
is correct.
Let's show the picture of Wesley Snipes. It was taken on his birthday in prison.
There he is. He's still looking pretty good. I think he turned 50 within the last couple of years inside prison. And so Wesley Snipes is actually part of a group of, lack of a better term, a tax protest group. You remember the exact name? It was like, might have been the tax protest group for all I remember. But so he was not wanting to pay his taxes, obviously, and finally they caught up to him and sent him to prison. And he turned 50 in prison. And the ironic thing, though, is who's funding the prison, right? Taxpayers, right? Somebody's got to pay for him to keep living, right? So Lamar Odom is a popular choice. He's had his problems recently, but not one of them is not going to prison for failing to file tax returns. So I don't know about Nicolas Cage. He's probably had his own problems, but. And I think we're stuck. Okay. So we want to kind of move into some of the strategies. We've talked about some of the doom and gloom. We've seen what the tax rates are doing and kind of what you might be up against coming up. So we're going to go into some of the strategies. Now, the first one, and this is really, really powerful that you really should look at for your business, your investments, is doing income shifting. And what we're talking about here is the ability to take money that's going to be taxed at your high tax rate and maybe giving it to a family member, maybe a parent, who's in maybe a lower tax bracket. So if they can help you in your business in such a way that you can pay them and take a tax deduction for it, now you're saving taxes at 30, 35, 40%. And for most kids who, if they don't have another job, generally they can make up to just under $6,000 tax-free. So a tax deduction to you, a tax-free to the kids, sounds like a win-win, right?
Yeah, and I think what we love about income shifting is, for the most part, it's money that you are probably giving to your kids anyways, right? But what a great way to help them, have them help you in the business, help them learn about money, about financial management, and at the same time get a tax saving for it, right? So if you just gave them money for them to buy a car, it's not a tax deduction. But if they are helping you out in your real estate or your investment business, and you pay them, that's a tax deduction for you. They can later take that money and go out and buy the car that they wanted. Sound good?
Yeah, I guess a great example of this is we were meeting with a client, I think it was not last year, but the year before, right around this time, doing year-end tax planning. We're just kind of beginning the meeting, talking to her, what's going on the weekend, what do you guys do? And she's like, oh, I'm taking my kids. She has 2 boys in high school. She's a sales executive, but has kind of a real estate business on the side, flipping, doing rentals, things like that. But she was going to take the kids out to help her fix up, do some painting and things like that on a couple of the flip properties. I said, well, obviously our head starts spinning, light bulbs are going off, ding, ding, ding.
It's not that bad.
It's not that
You
bad.
make it sound like weirdos.
Like we're dorks. But so we talked to her and we said, well, have you thought about paying them? And she's like, no, I hadn't really thought about that. And so we worked with her to get her kids legally, put on payroll for her business such that she could pay them. I think she paid them $2,000, $2,500 for the work that they ended up helping her with. So she got like a $5,000 tax deduction, which saved her probably close to $2,000 based on where her and her husband's tax rate was. And the kids didn't have to pay taxes on it because it was below their tax-free standard deduction. Mm-hmm. So it was really kind of an eye-opening experience for her because she never really thought about doing that. And as Amanda said, well, no, this is money you're giving the kids anyway, right? I mean, so it's a matter of how do we legally incorporate it in your business so you get a tax deduction for it.
Yeah, and trust me, most of the times our clients say their kids really love that. Kids love being able to learn and participate with you. Maybe even we have a lot of clients that will take their kids to educational events with them so they can learn about real estate and wealth building. And that's really great to create that legacy and pass that, financial competency on.
Now, some of the common questions we get in this area are, how old do my kids have to be? And we kind of always jokingly respond with, well, have you seen the diaper commercials, right? I mean, those kids are getting paid. Now, that's an extreme example, obviously. But in your businesses, there's not really an age, a minimum age they have to be. It's more, what you're paying them and how much you're paying them is appropriate for their age. So if they're 4 years old and they're your IT consultant, come on, that might be a stretch. Now, maybe a 7-year-old, that could probably work, but...
That may not be a stretch.
And that's what we kind of joke about with this picture up here. You kind of look at it and go, oh, this is really sweet. Dad's teaching him something about the computer. But you really know it's the other way around, and they're teaching Dad about... Another one, too, not just kids. I mean, changing demographics, changing economy. A lot of A lot of our parents are retired or semi-retired. So maybe look at if they're in a lower tax bracket than you and they can actually help you in your business, maybe look at hiring them. Now, you got to think about whether you want to work with your parents or not, obviously, but we actually had a lady at one of the presentations. She was kind of sitting up in the front row, a nice lady, and she kind of timidly raised her hand and said, well, my 30-year-old son just moved back in with me and, he lost his job. Does that mean I can, hire him and pay him in my business? And we said, yeah. And we said, so how many of you have the 30-year-old children who move back in? How many of you are the 30-year-old child that's moved back in? Don't be scared.
So if you are that 30-year-old that moved back home, you can go home and tell your parents, hey, I just went to a tax class, and guess what they taught me? They taught me you should pay me to be here, right? But in all seriousness, it's a really great way to get your family members involved. And, income shifting doesn't have to be family members. I have clients who, maybe have a girlfriend that they're dating who's in a lower tax bracket, right? What a great way to shift some income to them. The only caveat you're looking at is making sure the amount you pay them is reasonable for the job that they're actually doing for you. With respect to year end, the key here is make sure you have your documentation in place if you haven't already paid them, if you don't have job descriptions. Those are all things that need to be in place before the end of the year. So you have about 2 months to get that done. True story, I had someone come to me in April of this year that said, I went to your brunch year end and I loved your idea about paying my kids. I want to do that for last year. Guess what I said? It's not possible. You can't retroactively pay a child. So definitely something to work with your advisor on.
Let's go back there. So our next strategy is talking about tax-efficient profit extraction. And this is really just a fancy way for asking the question is, how are you taking the money and the profits out of your business? Are you doing it by default? Is there a strategy in place? Or, are you doing it by design or are you doing it by default? And kind of put some numbers or picture to it. As an example, we had a client, Ben, that we were working with, came to us a couple years ago, and he had a business where he would help, as a B2B business, so he'd help businesses find ways to reduce expenses and save money. So obviously you can imagine with the economy, as the way it was the last 3 to 4 years, his business really did take off. And so he was making over $200,000 of profit every year. And when he came to us, he was taking it all that profit out of the business as a salary. Now, he was living South Bay area up in, Long Beach, that kind of area. And, had a good lifestyle, a nice car, a nice house, all that kind of stuff. So he was just, without knowing it, just taking it all out of salary. The problem with this, though, is that he's paying the ultimate price in payroll taxes by doing that. So we started working with him and with his business, and he had an S corporation. So we looked at him and his business and helped him see how he could reduce his salary in his business, still keep it at a reasonable salary level for IRS standards, and yet it was going to save him a lot in payroll taxes. So I think for him, we reduced his salary down to around $100,000, and for him, it saved him about $7,000 in payroll taxes. Now, and this is a per year savings. So that's obviously year one, but going forward, if he can keep his salary at a minimal level, still within reasonable standards, obviously, then he's going to continue to save that payroll taxes every year.
This is especially important if any of you in here are active real estate business owners, so flipping, wholesaling, maybe even real estate agents, because your income could fluctuate pretty significantly from year to year throughout the year. So you always want to be monitoring what your salary is that you're taking from the business, because you don't ever want to take out too much salary, then you end up overpaying about 15% in payroll taxes. Like in Ben and a lot of our other clients, we look at other creative ways to take profits out of your business, because I know a lot of people, you do need that money to live off of, right? We can't just keep it in the company and live off of, a small salary. So some other creative ways to take money out would be via reimbursement plans, where the company gets a tax deduction, but we don't have to pick it up in income. A good example of that for anyone who have, any of you guys who have C Corps or operate as a Schedule C business owner, is the medical expense reimbursement plan. It essentially allows the company to take a tax deduction for your medical expenses, and you don't have to pick it up in income. Is that great?
Especially if you're in a situation where we were talking about earlier, we had that slide about medical expenses. For a lot of people, yes, those can be deductible, but then the question that comes up is to, when you add them all up, do they exceed a certain amount of your income? And you can only usually deduct the amount that's in excess of this imaginary threshold. So it's great for people who have C Corps or Schedule Cs, where now they can turn these medical expenses they weren't getting any benefit from into legitimate tax deductions.
Yeah, I think a couple other great ways to get tax-free profit extraction from your business is if you have a home office you operate out of, your company potentially could reimburse you for the cost of that home office. Okay, so that's something you can work with your CPA on. Or maybe you incurred car expenses personally. It's a great thing to meet with your tax advisor between now and year end to go through the list. What are some of the things that my company can reimburse me for in order for me to maximize my tax deduction? The key for year end is just like the income shifting, right? The money has to exchange hands before the end of the year. We can't reimburse you next year for this year's expenses and expect a tax deduction for that. I just want to kind of go back, our last pop quiz was about, who went to jail for not filing tax returns. And the concepts we shared today are all legally allowed by the IRS. Okay? However, everyone's tax situation is different. So something that works for you might not work for the person sitting next to you. So just make sure that if you think any of these strategies apply to you, that you're talking with your advisor before you actually pull the trigger on any of these. Okay?
And hopefully it goes without saying, but we're not here to talk about any strategies that are actually going to put you in jail either. So hopefully that's clear. But so our next pop quiz is, which of the following politicians was not forced to pay back all of his back taxes? And the answer is not all of the above, okay? So the first one is John McCain, Arnold Schwarzenegger, Tim Geithner, or Hillary Clinton. And takers. Sir in the middle?
Yeah. Tim Geithner, yes, very good. So we all know who Tim Geithner is, right? He was the head of the Treasury Department, which is, in essence, the head of the IRS.
Yeah, so Tim apparently, I don't remember exactly what he was doing, but he was making some money on the side. And
I think he wrote a book or something.
Oh, was it? So, and what happened was he didn't end up paying his self-employment taxes or payroll taxes for, I think, 4 years. And so when it kind of came out, obviously people were like, why didn't you pay your taxes? And this is still mind-blowing to this day, but he said, well, I used TurboTax and I didn't know any different. They didn't tell me. I was like, yeah, TurboTax made me do it. It's not an excuse,
So then he decided to pay his back taxes, but he only paid 2 out of the 4 years that he was behind on. So then the media went and interviewed him and said, well, why is that? We found out you only paid 2, even though you owed for 4 years. And he said, well, there's a thing called the statute of limitation, which means that after 3 years of filing my tax return, the IRS could not come after me for back taxes. So what I think about that's so interesting about this story is you see someone who claims to not know what you have to do to pay taxes, but he definitely knows the loopholes of how to get out of having to pay back taxes, right? And he just happened to be the head of the Treasury Department. But in all fairness, he did end up paying all of his back taxes. I think it was a smart political move on his end, just to make sure that he, did his duty as a citizen.
So remember, the moral of the story is TurboTax is not a good excuse. So one of the great strategies available right now is relation to bonus depreciation. Now, you guys probably know this in terms of depreciation. You buy equipment, fixed assets, things like that for your business. Generally, you have to write them off over time. You don't generally get to write them off all at once. Now, there are some exceptions to this, and one of them is actually bonus depreciation. If you buy a brand new asset for your business, the IRS will now say that you can deduct up to 50% of it right away, and then you can also deduct some of the remaining portion also this year. Now, one of the keys with bonus depreciation, it's got to be a brand new asset. Now, meaning brand new entirely, not just brand new to you.
Before someone asks this question, I'll just address it now because we do get that a lot. So the question we get is, if I buy a brand new home, do I get to write off 50% of it? And unfortunately, the answer to that is no. Real estate is an exception to the 50% bonus depreciation. Okay, but if you are in the real estate business, a lot of our clients buy washers and dryers, new appliances. A lot of those things are eligible for bonus depreciation, provided that they're brand new equipment.
Another one that we get, and I don't know why this happens all the time, but it's generally this question comes up near year end. But we were meeting with a client last year. They came into our office, husband and wife, and he has a very profitable kind of real estate brokerage business, and so he was making good money. So obviously we're looking for ways to reduce his taxes. And we said, well, are you looking to buy any equipment, new assets for your business? And he's like, well, kind of really looking at a new car. And so he and I are kind of like eyeballing, well, what kind of car are you looking for? Guys start talking about cars, right? I'm like, well, because if you buy a really big car, you can get a really big tax benefit for it. And so his eyes light up and everything, obviously, and his wife, you can see beads of sweat start running down her face and save me from this, But in all seriousness, we were talking about the situation where if you do buy a brand new car that happens to weigh over 6,000 pounds, so like a large SUV, large vehicle, something like that, the bonus depreciation can't apply to your situation. So in Mike's situation, he was looking at one of those, I think, brand new Lexus SUVs that cost something like 60 grand. And he wasn't going to put very much down, maybe like 10% at most, I think, if I remember correctly. So for him, we were able to look at the situation, and by utilizing bonus depreciation, utilizing Section 179, which is another depreciation strategy, we were going to be able to write off close to $40,000 to $45,000 of a tax deduction for that vehicle in the first year. Now, for him, this is what's really, you obviously have to keep in mind is it's going to apply to the business use percentage of your vehicle. Now, for him, he was going to be able to show that it was 100% business use because he actually had 2 other vehicles. So he really was going to use it all the time for his business. And so he, if he put the 10% down, he put maybe $6 grand, but he got a tax deduction for 40 to 45, which in his tax rate saved him $15,000, $20,000. And so now, obviously, you can use bonus depreciation. You buy a new sedan, you can still use bonus depreciation, but they're going to put limits on. They're going to cap how much depreciation expense you can claim in the first year and every year thereafter. There is no cap when you buy a large vehicle. So obviously, I guess the IRS is trying to incentivize people to buy either gas guzzlers or on the opposite end, they're giving you energy efficient credits for solar cars or something like that. But either spectrum.
Yeah, so something to think about if your business needs assets, again, doesn't have to be cars, it could be furnitures, appliances, even stuff for your home office, potentially could give you the bonus depreciation benefit. The key with bonus is that is set to expire at the end of this year, so maybe even look ahead. What are some of the equipment or assets you anticipate needing to get in January of next year, whether you pay for it cash by year end or even if you charge it on your credit card by year end, those should be 2012 tax deductions for most of you. Okay.
Now, another strategy related to depreciation, let's shift gears a little bit and talk specifically about rental properties. And that has to do with cost segregation. So all of you who are investing in rental properties probably know this or should know this. But generally with rental properties, you can write off a residential rental property over 27 and a half years or commercial property over 39. Now the benefit of cost seg is it's a way to look at your properties and break down the purchase price of those properties into smaller components and write those smaller components off over 5, 7, or 15 years. So this is really going to help your cash flow because obviously every extra deduction you can get to reduce your taxable income is going to help you now. So, obviously you're going to get the same depreciation over the life of the asset. It's a matter of when do you take it. And so cost segregation is a great vehicle for looking at being able to take, 20, 30% sometimes of your purchase price and write it off over 5 or 7 years instead of 27.5 or 39.
And if it happens to be new construction, then those assets that were depreciating over shorter lives, potentially we can double up and use the bonus depreciation, right, if we claim it correctly for 2013.
We had a kind of a tidbit here. Is we had a client that came to us last year, and he had good portfolio of rental properties, also doing fix and flips, probably like a lot of you in the room. And he had a property that was really good cash flow, kind of a commercial property. And he was under the impression that he couldn't do a cost segregation study because he'd owned the property for a number of years. And this is actually not true. You can actually do a cost segregation study and file a form with the IRS to catch up the depreciation that you missed by not doing it, say 5 or 6 years ago when you bought the property. And so for our client, it was an extra, I think the final number was like $250,000 of a write-off for the extra depreciation on this big property that he could have accelerated, 5, 6 years ago, but now we're helping him claim it all now. And so for him, that was, he was going to save $80,000, $90,000 in taxes. And we just filed his return 3 weeks ago, and it all came to fruition where you could finally see the final numbers, and it really did make a lot of sense.
I think just as a general rule, cost segregation is not for everyone, so make sure you talk to your tax advisor before investing your time and money into a cost segregation project. But the main thing to look for generally is that if you have whether one or multiple properties that have depreciable bases of over $500,000, those are more ideal candidates. But for any of you investing in California, one or two properties will probably already give you depreciable bases of over $500,000, right? So it is a great loophole for a lot of us investing in California. The second thing is, just make sure that you are someone who gets to use all of your real estate losses, that because of your income or because of your W-2 job, that you're not going to be limited by how much real estate you can deduct. Because what you don't want to do is get into a situation where you spend money to have someone come and help you maximize your write-offs, and then at tax time find out you can't use those write-offs because of some quirky laws that says this is limited due to income or limited due to what you do on a day-to-day basis. Okay?
Yeah, if any of you are investing in single-family homes and you're buying a good number all in kind of the same general geographic area, this can really, really benefit you because of economies of scale. Because the cost segregation, you hire a team to come out and analyze the properties, and obviously if they're all within a general area of each other, they can kind of bang them out sequentially, whereas if you were spread out over different states or something like that. So for those of you, that could be really good too. Oh, go back there. So our next thing, retirement planning is one of our favorite topics to talk about from a tax planning perspective because there's so many options. I mean, we've done 1-2-day classes just on this topic alone. So we're going to kind of scratch the surface today. Karen's obviously going to come up after us, Karen Hall with UDirect IRA Services. She's going to talk a lot about self-directing your IRA and different options you have there as well. So, and then obviously at the end, if you have questions, we can go over them as a panel too, because we tend to get a lot of questions in this area. So kind of one of our presiding themes of the retirement planning, and again, this is going to be to each person's own situation, but presiding theme is, if you had the option, why not pay your retirement account instead of the IRS? I mean, it seems like kind of a no-brainer right now. There's some times where that may not necessarily make sense, but for the most part, that's kind of our overriding theme. So today we want to kind of go over a couple of these tidbits that you guys can utilize in your situations to maximize tax deductions, build your retirement account, build your wealth, and maybe even use that retirement account to redirect and invest in things that you have a good skill set at, like real estate. So one strategy is, I don't know if any married couples where maybe one of the person is working and the other spouse is maybe stay-at-home parent, not earning a quote-unquote money right now as an earned income. One of the things they can do is what's called a spousal IRA. So the non-working spouse can actually still contribute to their own IRA, and the tip here is that you have to have earned income to be able to contribute to an IRA. So what they let you do is they say, well, you earned at least what you need from your spouse, $5,000 or $6,000 to put into your own IRA. So a lot of people don't know that. It's been out there for a long time, but like I said, a lot of people don't know it for whatever reason.
Yeah, so typical profiles, maybe a husband that has a corporate job making W-2 and the spouse is to stay at home. Well, that's a great candidate if the spouse wanted to set up a self-directed IRA with Karen, for example, right? They can build up that money and maybe invest in real estate or in trustees. I think another common misconception is if you're someone who makes W-2 income full-time and your employer has a 401k plan, that you're not allowed to contribute to other retirement accounts. And that's false, okay? So just because you have an employer-eligible plan, it does not necessarily mean that you can't contribute to other plans or have a 401k of your own. Okay, so there are opportunities if you happen to have a W-2, but you also happen to have your own side business. Let's say you do some wholesale, or you're a realtor on the side. That's a great opportunity for you to also open and set up your own self-directed retirement account. Okay, the key with that, with a lot of retirement planning, we all know that we can put in $5,000, $6,000 in an IRA before April of next year, right? But there are a lot more powerful plans where we can put in $50,000 or even over $100,000 per person into the retirement plan and get a tax deduction for it. And when it comes to a lot of these more sophisticated or more powerful plans, they actually have to be set up before the end of the year, even if you contribute next year, we can still set it up this year so that you can take a tax deduction for it for 2013. Okay.
So it is important to kind of, for your own situation, figure out which retirement account is, work with your advisor, figure out which one's going to make the most sense for your situation. Maybe it is one where you don't have to set it up by year end. But like Amanda said, a lot of them you actually do have to set up. And some of them you have to actually set up and fund by year end. Some you can fund next year. So again, there's a lot of options out there. I mean, we met with a client probably back in March or April, a new client to us, and he'd been working with somebody else. And this person had it's called a sole proprietorship business. He was making $120,000. And his previous person had said, oh, you can contribute about $5,000. We actually looked at his situation, and he could have done a couple different options. He could have done a SEP IRA where you could have put in 20 to 25. But for him, actually, based on his age, he was an ideal candidate for a defined benefit plan. And so when we kind of worked with one of our team members, we ran some numbers. He actually could have contributed maybe up to $40,000 to a defined benefit plan, got a tax deduction now, and it would continue to grow tax deferred for 10, 15, 20 years into his retirement years. Mm-hmm. So again, it's not one size fits all, but just figure out what works for your situation and figure out what you want to do with your retirement money and how you can utilize that to the best of your advantage.
Yeah, and we're so lucky to have Karen here because she's going to come on up right after us to talk about, now that we have money in the retirement account, what can we do with that? All the wonderful, fun things we can do with retirement.
She was just bragging to us at dinner last night that she went to a training and all this information was flowing into her head. And I'm not doing it justice as how she was doing it, but so I think she's got a lot up there that she wants to share with you today.
So we wanted to leave with a few interesting tax deductions. We started today off with 4 items that were tax deductible. Here's a couple other ones that were allowed by tax court, U.S. tax court. Some examples: pet food, wigs, babysitting fees. There you have breast augmentation again. Swimming pool. So these are just to show you that all sorts of stuff could be tax deductible. The question really just is, how can I make it tax deductible, right? So it's having that conversation with your CPA. What I always tell people to do is, instead of just asking your CPA, can I deduct this? Ask them, how can I deduct it? Because that puts them in a mind frame to think more from a strategic perspective and say, okay, how can we make this business related? How can we make it real estate related? How can we make it medical related, right? And use the loopholes to our advantage.
Now, Amanda gleamed over this, but there was some creepy giggling in the front row up here about the last one on the list, girlfriend. So I'll just throw it out there. This is actually a story. It was real estate property owner was paying his girlfriend being a property manager. When the IRS got a hold of this, right, come on, But he actually took it to court and he won the case. Mm-hmm. And we were doing a speaking event once, and we kind of gotten off stage, and kind of people were reacting the same way you guys were reacting, and they said, "What about girlfriend?" And I just didn't have this time to go into the story, so I just blurted out, "Oh, he was paying her for services," and I just didn't really go over so well, but.
I just want to let you guys know we have some CDs. They're top 10 tax saving strategies for real estate investors, where we talk more about entity structuring, real estate professional, maximizing tax write-offs. And if unfortunately I don't have enough for everyone here, but if you would like a copy of it emailed to you, just make sure you stop by our desk outside and give one of the girls your email information, and you can receive that via email probably on Monday.